We are really excited to be here with Dr. Chris Thornburg from Beacon Economics. It's a ongoing economic forecast series. We actually started doing webinars for our members back in 2023, and we've got two types of webinars. One we do from Nuvision Insights, and then one with these Beacon Economics in partnership with Dr. Thornburg. And it's all about providing our members with what we hope is some really valuable, insightful information so that you can make the best decisions for your lives. So we're really pleased you're here, and hope you find this to be a valuable webinar. It is recorded, so that's typically a question we get: is it recorded? And that it is recorded, and it'll be available shortly, after the conclusion of the live webinar here, because we know some like to go back and review, see some of the slides. Chris has a lot of great content, so you might want to go back. And we have many members who aren't available to attend the live webinar. So we'll go to the next slide. Just a reference, an important reference to our purpose here at Nuvision. We help people build. We help build lives for people. We're talking about our members, talking about our communities, as well as our team members. And when it comes to our members, this is a big part fulfilling our purpose. Walking that talk, if you will. This is one of the key proof points in terms of what we do to serve our members is by providing these educational webinars. As I mentioned, we do the Nuvision Insights. We did one as recently as just February, and that one focuses more on topics and subject matter experts from the credit union. For example, we had some of our team members talk about fraud and how to protect yourself from various fraud trends and such. So that's one example, and in fact that is available in our Nuvision YouTube channel if you didn't get a chance to check that already, because I think it's a really valuable webinar. And then we also have, as I alluded to earlier, these these webinars partnering with Beacon Economics, because we know for many of our members, the economy and the state of the economy has a lot of impact on your lives, and thinking about and understanding what to expect going forward is something that members are interested in. So that's why we're so thrilled to be here with Dr. Thornburg to provide you some great information from his years of expertise. Now we go to the topics. These are broad topics, and Chris talks about a lot of nuances here. So this is broad brush topics, but he'll be sharing more about the current state of the economy, including, how's the U.S. deficit doing, talking about, things like the housing market and unemployment situation. There's also always key indicators to watch for. So he'll be highlighting those. And, with any kind of discussion about economics, there's always opportunities, of course, but there's also challenges and risk areas. And things we should at least be on the lookout for might be international events, other things that are, more domestically focused. But Chris will talk about those as well. And then always of interest is what should we expect looking forward in terms of economic environment and just overall performance. And Chris will be, highlighting that as well. So we've heard, as many of you probably know, so as you registered, we ask you for topics that you'd be interested, because when we talk about economics, it's a very broad topic. So we really appreciate many of you providing your specific topics you're interested in. We've shared those with Chris, and we'll do our best throughout this evening's webinar to touch upon those topics tonight. And if we don't get to all of them in the core content, as noted on the topic slide here, we've got a Q&A. So I hope you'll take advantage of that. And as a reminder on the Q&A, this is a Zoom webinar, so you can use that, click on that Q&A icon at any time, and you can submit your questions. And then after Chris finishes his presentation, I'll come back on, and together we'll facilitate addressing as many of those questions as we can. A couple of ground rules when it comes to the Q&A. One, we encourage you, we can't answer really specific, like member specific account related questions. And we would ask you not to put any kind of really specific like account numbers or anything like that in the Q&A. The other thing is, we know from some of the questions we got up front when members registered, that there's some interest in investment advice type questions. And that's something we're not able to, it's beyond the scope of a webinar like this. But if, and I'll give you later as we get to the Q&A and close out, I'll give you an email address that you can share, that you can use. If you'd like someone to follow up with, we do have an affiliate or affiliation with LPL Financial, and we partner with them for investment services, and we would be happy to connect you with one of our investment advisors who could really advise you on those investment related questions. So, with that said, just again, I know some of you, because I've talked to members before who I know attend these, and so many of you have been at these before, but there could be some people who this is their first Beacon Economics webinar with Nuvision, and so I wanted to give you a little bit of background on Dr. Thornburg. He's a leading economist, founder of Beacon Economics, and he's with us to help make sense of the factors affecting the economy, what's on the horizon, and what it means for all of us. Like, so what? What's the impact? Chris has 25 years of experience in providing accurate, insightful analysis of economic conditions. And what I so appreciate about Chris is he's you can actually, when he says things, you can generally understand them quite well what he means. It's very understandable, and he really does take so many of those headlines in the mainstream media that we hear and really kind of cuts through and uses the data to say, well, here's what really matters. Here's what the deal really is, what you should pay attention to, not necessarily those headlines we might see on the news or in publications. So we're really looking forward to hearing from Dr. Thornburg. Again, he's our national recognition. He's an expert. And if you haven't heard him before, you're going to really enjoy it. And if you have, you're in for another treat as you had the last time. So with that, again, just want to remind you on the Q&A, as we're going through the Chris's presentation, you can click on that Q&A icon at any time, submit your question, and we'll do our best to get to as many of those, or at least the themes of the questions, depending on the volume, and before we wrap up the webinar. So with that, it's my pleasure to say good afternoon, good evening, depending on what time zone our members are in, to Dr. Chris Thornburg. Hi, Chris.
Hey, Roger, how are you? Nice to be back. So, are all my old presentations online as well?
I think they all.
So
I'm not
people can
sure if
actually go
every one of
back
them
and
are,
check
but
what I said a couple of years ago. That's
yeah. Well,
great.
there could be some questions where they said, "Hey," because Roger said you were accurate, and they might go back and check one and
I,
then
I
call
actually
you on it.
encourage that, and we'll also if we'll also try to get a PDF of the slides out to folks as well. That'll probably be delivered after. So another way you could peruse this stuff. Well, thank you,
Great.
Roger, for that lovely introduction, and it's great to be back with you and New Vision Credit Union to talk about the economy here in the well. Tomorrow's May 1st, so we're a third of the way through 2026. We got two-thirds to go, and the question is what is gonna happen now? To kind of remind everybody, I have this company called Beacon Economics. Roger told you about it. I've been forecasting for actually 26 years now. I started back in 2020, but I started Beacon 20 years ago. It's been a wild ride. It's hard to believe I've had my own company for this many years. We have a nice crew of people. We do all sorts of reports, but most of the time, what I do is try to help people understand what's going on out there in the real world. And for those of you who've seen me, you know I have a very specific approach when it comes to talking about the economy. I start out by explaining that this is going to be a tale of two economies. And I know you're thinking, oh, well, he's talking about the rich versus the poor, or he's talking about the blue states versus the red states. But actually, what I'm talking about is the economy we think we have versus the economy we actually have. One of the things I've noted for most of my career is this big gap between what I see in the data and what I see in the papers. And I got to tell you that at first, I thought it was kind of funny, but then I started realizing it's not funny. In fact, it's really important to pay attention to the difference between narratives and reality, in part because narratives drive choices, but it's reality that drives outcomes. And ultimately, good choices and smart policies start with the correct narrative. And I'll tell you, the biggest problem we have in our economy right now is the gap between narratives and reality, driving all sorts of bad choices and all sorts of bad policies across this nation at this particular point in time. And I got to tell you, I'm not the first guy to point out this particular the fallibility of human beings. In fact, one of my favorite Southern California philosophers over 100 years ago quipped, "It isn't what we don't know that gives us trouble; it's what we know that ain't so." So Will Rogers understood the dangers of false narratives a long time before I did, and it's words of wisdom to live by. There's no doubt about it. Um, and when you think about where our economy is right now, we all know the big narratives. And of course, I already have a bad animation in my slide deck here. I so apologize. But if you could see back there, you'd see the University of Michigan Consumer Sentiment Survey, which you've heard the papers, has dropped to an all-time low level. On the right-hand side is a policy uncertainty index, which, after calming down near the end of last year, spiked up again with everything going on in the Middle East. And a recent Gallup poll I found was interesting because a lot of these topics we're going to address today. What are people worried about? They're worried about healthcare. They're worried about the economy. They're worried about inflation. They're worried about federal deficit. They're worried about income and wealth distribution. A lot of things to be talking about, and we're going to try and touch on most of these today. But of course, we also understand that a lot of these worries come directly from these negative headlines. Whether we're worried about weak hiring or the K-shaped recovery or the affordable housing crisis, or of course, oil at $100 a barrel and likely to stay at $100 a barrel, at least for the next little bit of time, given that nothing is occurring in terms of negotiations over opening the Straits of Hormuz. Little wonder, of course, that Mark Zandi, the chief economist of Moody's, is out there talking about how we could be on the edge or already in a recession at this particular point in time. But before we get too worked up about yet another economist calling yet another recession, let's just keep in mind the forecast accuracy over the last decade or so. In 2019, I'm pretty sure it was Zandi who called the real estate recession, the one that never happened. And of course, in 2020, Zandi, along with all sorts of other folks, including the economists at the Federal Reserve itself, had all determined that the pandemic was going to cause a depression. It didn't. In fact, it was a relatively sharp but very short recession. 2023, there was another recession. That time it was an inverted yield curve. And last year, we were told the tariff could possibly cause a recession. Again, none of these things happened. And this is nothing new. In fact, Paul Samuelson, one of the most famous economists, famously quipped over 50 years ago that economists have predicted 9 out of the last 5 recessions. So missing a big call like this, pretty much par for the course. And what's so interesting, of course, is even as everybody's panicked about Main Street, Wall Street can't find anything called down. The numbers keep going up and up and up. U.S. market capitalization right now is 45% of overall global market capitalization, up from about 36% a few years ago. Look, to be clear, the last time we had that much of global market capitalization was, back during the dot-com bubble. Not exactly a good metaphor. On the right-hand side is primarily NASDAQ. That's at almost $20 trillion of market capitalization. And it's NVIDIA and Alphabet and Apple and Microsoft, these tech companies in the middle of this AI rush we're seeing in our economy today. And, I'm asked all the time, is it a bubble? There's all the debates. Is it a bubble? Of course it's a bubble. Of course it's a bubble. The PE ratio is 40. The only time the PE ratio was anywhere near that high was, of course, yet again, back in the run up to that big meltdown in 2000. And it's not to say that AI isn't an important transformative technology. Of course it is. But that's a different conversation. The conversation about stock market prices is whether any of these companies will make any money off of AI, which to date is a big fat no. So we're making a lot of bet on money that hasn't materialized. And that, of course, is while I'm worried. And don't even get me going on the crypto stuff. I mean, crypto took a big hit over the course of the last 6 months. It's lost 60% of its value, but Bitcoin is still running at $76,000. And the overall cryptocurrency market is still running over $2 trillion. This too just doesn't make any sense. And, again, wisdom of the ancient philosophers, be fearful what others are greedy. Warren Buffett said that's been his market, shall we say, strategy for a long time. It worked well for him, and it's something we ought to think about. You ought to be a little fearful because Wall Street's looking pretty greedy right now. Now, the big picture is very simple. For all the panic points in our economy and the dismal confidence, Reality is the economy is going to continue to grow because of one basic reason, the mighty U.S. consumer. U.S. household finances are about the best they've ever been. Thus, they continue to spend and drive business finance, which is also positive. Also important for our economy right now. There's more fiscal and monetary stimulus being thrown in our economy right now, both with the Fed going into ease mode, as well as what you're seeing in terms of the one big beautiful bill, which is expanding deficit spending. Now, it doesn't say everything's up. We know we have the political uncertainty. We know we have these issues with rising energy prices, and population growth has almost assuredly come to a halt. All of these things are drags, but they're not enough of a drag to keep the economy from tipping into a downturn. As for housing markets themselves, we're going to spend a little time talking about housing today because a lot of people have, I think, a very skewed opinion of where housing is and what they may or may not do on it. Housing is not exactly what you think. Look, it's a lot less affordable now than it was 7 years ago, but that said, it's not all that unaffordable. The real problem out there is a function of supply and filtering. What we need is a lot of cheap houses getting put into place to allow those entry level folks in. But we're not doing that, particularly in places where we really are behind on housing, such as my fair state of California or Washington State or some of those other big metropolises out there. And of course, the reason we want to talk about housing is, well, when we get into it, you're going to see that one of my basic opinions, forecasts right now, is that interest rates are not going to go down. They're going to go up again. So for all of those who are waiting on the sidelines for interest rates to come down, well, you're probably going to end up being disappointed. Now, it isn't to say everything's great in our economy. In fact, while I pointed out that the reason the economy will continue to grow is strong household finance, the worry is why household finances are so strong. Look, I like to say predicting the next recession is a game of spotting the imbalance because it's some big imbalances that will suddenly snap, creating a negative shock to the underlying structure of aggregate demand, and that sets off the conditions we call a recession. The two big gaps in our economy, those two big imbalances are very clear. The big financial bubble, but more importantly, is the federal deficit itself. The reason household finances look so strong is that the government is subsidizing your average American household to the tune of $15,000 a year through, of course, deficit spending. Well, that's not sustainable. And when Americans have to finally start paying their taxes and getting less benefits, well, that could be the strong shock to the economy that could set off the next recession. What will that look like? Well, we're going to have to wait and see. But in the end, most of the problems I'm going to tell you about today are problems that are easily solvable if we can have the right conversation. And that's the problem. The biggest issue out there is we can't have the right conversation. The biggest imbalance in our economy is the imbalance between our narratives and our reality. So where are we in terms of the economy right now? Well, look, growth in 2025 wasn't all that bad. It was about 2.1% growth overall. And if you look at what the slowdown was, it was primarily federal spending. That is to say, whether you're talking about the DOGE cuts or the extended closure of the economy last year, it was not a pullback in private demand. It was a pullback in the public sector. And by the way, there's a big bounce back going on right now. And for those of you who didn't see it, we just got our Q1 numbers out this morning. They're on the left-hand side. About 2% growth on par with last year. A little bit of a slowdown in consumer spending. A big widening of the trade deficit. Probably not a big surprise with the tariffs going away. But government consumption, as noted, has been bouncing back after that drain on the economy last year. Now, where are the consumers right now? Well, look, consumers have been doing fine. Yes, there's been a little bit of a slowdown in consumer spending at the start of this year, but consumer spending ebbs and flows on a quarter to quarter basis. We also had a really bad quarter for consumer spending in the first quarter of 2025 with a giant bounce back in the middle of the year. I'm not so worried about it at this point in time. And indeed, if you take a look at what people are doing, one thing to pay attention to is auto sales. I like auto sales because it's a good leading indicator where people are. We had a couple bad months, but in March, auto sales zoomed up, and that again is a sign that people really are trying to jump back into the mix. Restaurant spending's looking good. Nevada's still busy at this particular point in time. And of course, Live Nation pulled in a cool $25 billion last year in terms of people spending money on tickets. Yeah, this does not sound like a struggling U.S. population. Even travel. We know hotels are struggling a bit, and we know, of course, that overall flying in the U.S. has kind of flattened out over the last couple of years. But it isn't because people aren't traveling. Quite the opposite. The problem is that Americans are traveling abroad at a record level. Indeed, real spending in 2025 compared to 2019 suggests that people are spending about 65% more money in inflation adjusted terms overseas. Now, it's easy to look at that and blame the current administration, but it's worth noting that this has been going on for a couple of years now. And of course, with the folks never really came back to the United States, regardless of who was president was, really going back to about 2017, 2018. This is not a question of politics. It's a question of the fact that the dollar is at a 40-year high. It's expensive to visit the United States at this particular point in time and will remain so until that dollar comes down. The problem is when that dollar comes down, well, that could set off some other ugly events inside of our economy. Anyway, consumer debt still looks really good. Very few foreclosures or bankruptcies. Transitions to 90-day plus delinquencies, again, remain relatively flat over the course of the last couple of years. And really, Americans have been shedding debt. Take, for example, housing debt that peaked at about 90% of disposable income back in 2008. Well, that's now dropped below 60% of household income. Even non-housing debt, which includes autos and credit cards and student loans, that was peaking out prior to the pandemic. It had a little less than 26% of disposable income. It's not on at 22%. So actually, people are in a better debt situation now, really, than they've been in decades. And on the right-hand side, the people who are borrowing seem to have relatively good credit scores. You can see that, of course, in terms of some of those auto loans. Indeed, if you take a look at some of the areas that Nuvision's in right now, you can see it, whether it's Anchorage or Los Angeles or Orange County or the Bay Area. In all these places, the share of the population with the subprime credit score is lower now than it was prior to the pandemic and way lower than it was a decade ago. And on the right-hand side, it's a little bit of a breakdown in credit union delinquencies, which, by the way, across the board are lower than the overall consumer numbers. Credit union folks, they're good. They're good borrowers, as the case may be. Now, none of this is surprising when we recognize that real per capita income and real household net worth have actually gotten to an all-time high level coming into the end of 2025. That, of course, is driving the show, but we all know the pushback on that. Well, that's nice for the top 10%, but everybody else can barely feed their family, barely keep a roof over our head. It's the new Gilded Age, the K-shaped recovery. But even here, more narrative than reality. Take a look on the left-hand side. This is a breakdown in real income growth, inflation-adjusted income growth by quintile of American households. And it is true the top 5% out by about 31%, but the bottom 80% about 22% increase in income over the last 10 years. In other words, not K-shaped. Everybody's doing better, but there's a little bit better at that very top level. But of course, remember, this also gives us kind of a skewed version of what's going on because it only looks at gross income, which is not a fair representation. You know why this is not a new Gilded Age? Because in the old Gilded Age, they didn't have Medicare, Medicaid, Social Security, food stamps, Section 8 housing vouchers, and all the other programs we have to help needy families. And while I don't at all think it's bad that we have these programs, to discuss inequality without accounting for these programs, well, that's when I start having a problem. And these are big spending items. Last year, our government spent $4.4 trillion on transfers to American households. That's 20% of household income. One out of $5 of American household incomes come directly from the government as an in-kind or cash transfer from a government authority. One out of five. When you actually take this into account, turns out things don't look so bad. Indeed, on the left-hand side, this is a breakdown of net income, again by quintile, accounting for, of course, both taxes paid and benefits received. And it turns out it's the top and bottom quintiles that have seen the biggest increase in their net incomes over the course of the last 20 years. The top 20% because of the tax cuts they got, and the bottom 20% because of the benefit increases. Sounds great, except for the fact that when you cut taxes and increase benefits, well, you end up borrowing a lot of money on the public dime. And that, of course, is the problem we already mentioned. But you have to take this into account. In fact, the official poverty rate in the United States is 11%, but once we account for transfer programs, it has fallen to a record low 0.5% inside the US economy right now. Now, I'm not saying there's not a problem, there is, but it's not the problem we're talking about. It's not that people need more assistance. The question is why do so many people need assistance? It's the old give a man a fish, you feed him for a day, teach a man to fish, you feed him for a lifetime story. In other words, this is not a question about increasing benefits, but how do we make sure fewer households actually need those? And by the way, it's not complicated. We know the primary sources of these things: not getting enough education and being a single parent, not having job opportunities. These are the things that push households into poverty type conditions. Work on lowering these issues, and overall, we're going to have a more verdant, equal economic outcomes in the United States. Um, and what about food? What about shelter? I thought they were so expensive, right? Well, I know you've seen all the headlines, but again, let's look at actual data. On the right-hand side, this is food spending as a share of the overall bundle of consumer spending. And it turns out that, yeah, food prices have come up a bit, but despite that, Americans are spending a record small share of their income on food at this particular point in time. Only 6% for food out of supermarkets. Go back to 1996, and it was 8%. So it's the lowest it's ever been. And last year, for the first time ever, something very interesting happened. People spent more money at restaurants than they did in the supermarket. Gee, honey, food's so expensive we have to eat out again. And as for shelter on the right-hand side, well, only thing we have to do is take a look at the median rent to income ratio. We're constantly told there's a housing crisis, but boy, I sure don't see it in this data. What I see is that median rent to income ratios, while they've come up over the last couple of years, have only come up from the lows they were at back in 2019, and they're back to what you would call kind of long run normal levels. This is not a crisis, this is a return to normalcy. And by the way, again, neither one of these numbers actually contains benefits. For example, 42 million people get food stamps. 2.4 million households get housing vouchers to help them with rent. The average voucher for an American family getting this is about $16,000 per year. So, yes, if you cannot really have this conversation without discussing these sort of things, but people do. We hear about the hunger crisis. We hear about the affordability crisis. Why do organizations put these stories out there? Well, I have my own new expression, which is give a man a fish, you feed him for a day, teach a man a fish, and you'll lose your nonprofit's funding grant. We have to keep in mind there's a lot of people out there whose incomes depend on keeping this spigot flowing, and they will put out stories to keep that money flowing out there into the economy, whether or not people actually need it. We have to understand these incentives. And again, I'm not saying people don't need help. What I'm saying is we're helping people. The trends are moving in the right direction, and we should celebrate that as opposed to working ourselves into a panic over a crisis that doesn't actually exist. In fact, if I had to tell you what the real problem was with Americans, they're over consuming. And I know that's a weird thing to say, but work with me. Take, for example, the fact that consumer spending as a percent of GDP is right near an all-time high level. And we should note that the trade deficit has been running somewhere between 3% and 5% of the US GDP for 20 years. The trade deficit is the difference between what we consume and what we produce. We have been over consuming for almost 20 years. And if you want to know why, again, it's public borrowing. We have been paying out benefits, but we don't use taxes to pay for it. The government borrows, and that gives us the perception we're richer than we are. And that is exactly why people are overspending. But we could only continue to do that as long as our government continued to borrow. And that, of course, is where the problem lies. How big are we talking? If you wanted to close our $2 trillion deficit this year, you'd have to increase taxes by $15,000 per household. That's 9% of disposable income or 25% of federal expenditures. These are big numbers, and it's just not something we can do rapidly. It would cause havoc in our economy. But until we have the right conversation, it's hard to see us fixing this. But do people recognize any of this? No. They hear the stories. People are panicked about the next 5 years. Anticipated life slumps to a record low. 74% of parents think their kids are going to be worse off than they are. 7 out of 10 college students say the country is headed off on the wrong track. I think I may have shown you this before. It's a wonderful graph that comes from the Federal Reserve. What it is that they ask a whole bunch of folks, how are you doing? Specifically, your household. The top line is the share of people who said we're doing okay or living comfortably. That hasn't changed. But look at the other numbers. This is those people, the percent of those people who said the local economy was doing good or excellent, or the national economy is doing good or excellent. It's a weird thing to see, but what's happening here is the average person in the U.S. thinks they're doing fine, but the average person thinks the average person is struggling. That's the bizarre gap between our narrative and our reality. Now, it's just not just this stuff. Business activity still looks very good at this particular point in time, whether we're talking about real private fixed investment or business profits right now. Industrial activity, including manufacturing, has been picking up. Manufacturing profits, by the way, all-time high level at this particular point in time. Construction trends remain positive. Yes, building of new single-family homes is down, but people spending money on improvements has actually been rising. And yes, data centers are a big part of this, but they're spending on automobile centers and food stores and lodging as well. So, yes, things are pretty good. Bank debt still looks clean. Bankruptcies are down, and job openings are only about 4% right now, which is basically where they were in 2019. So, where are the jobs? Good question. And it is a very, very cold labor market. There's no doubt about it. You can see on the left-hand side that in the last couple of months, we've basically been adding no jobs. Our job growth year over year has gone to about 0%, which is very odd. We typically only see that when we're actually going into a downturn. And the hirings rate is incredibly slow. And by the way, it's not just a few states. Everybody's seeing a big slowdown. From struggling California to rapidly growing Texas, everybody's seeing a big slowdown right now. But a slowdown is not the end. In fact, if you take a little bit of a closer look, you'll see that layoff rates are low, initial claims for unemployment insurance is low. Indeed, the U.S. unemployment rate remains to stay here over 4%. None of this tells me that tons of people are getting laid off. In fact, the real problem is people just aren't changing jobs, which is kind of odd. And, it's interesting. Again, I like the Gallup polls not because I think they help us understand the economy, but they really help us understand the narrative. And this is a really interesting one. They ask people, is it a good time or bad time to find a better quality job? And look how these numbers are dropping. Everybody thinks it's a terrible time to go out and find a job right now. I'm not sure why. And of course, workers now claim more of them are struggling than thriving. I'm not sure what that means. But again, people seem to be basically unhappy. But again, let's look at the data. What I have for you is data from the Atlanta Federal Reserve using data from the census itself, looking at hourly earnings. I've inflation adjusted this, so it's real. This is year over year growth. And on the left-hand side, well, it turns out incomes are growing in real terms. They've slowed down a little bit in the last year or so, but they're still within the normal range we've seen over the last few years. And by the way, they've been growing better for the lower half of workers in terms of wage distribution than the upper half. By the way, on the right-hand side, in the middle there, that's real median earnings, same calculation, but now it's for job stayers and job switchers. It turns out it's worse to be a job stayer right now. You're better off actually switching jobs. You're likely to see better real income growth. And breaking it down a little bit on the right-hand side, whether we're talking about race or age, none of these numbers suggest to me that American workers are actually struggling or falling behind very much at all. They seem to be doing quite well. Yes, even Gen Z. Susie Welch from NYU says Gen Z and millennials are burnt out because older generations work just as hard, but they had hope. Now, to be clear, I don't think Gen Z worked just as hard. But putting that to one side, I like the article that was in The Economist a couple of months ago where they point out that Gen Z is actually unprecedentedly rich. Yep, you heard me right. The Economist did a really interesting article where they looked at real wages, controlling for age, and as it turns out, Gen Z, well, They are making more money at their age than any previous generation. And I do appreciate on the right hand side that there's been an uptick in the unemployment rate for kids with a bachelor degree. You probably have seen some graph. It's about 7% at this point in time. But what does this tell us? The overall unemployment rate in the United States right now is just about 4.2%. Job openings are there. So does this reflect the fact that these folks can't get jobs or they can't get the job they want? That's a completely different thing. And no one's truly been able to divide that in this particular data. Given the overall health of the labor market, I expect it's the second one. It's that they can't get the job they want. In fact, I'm going to continue to argue that the biggest problem in the US is that we don't have enough workers. Look at the left-hand side, the big slowdown in labor force growth we've seen over the course of the last 40 years or so. And yeah, that's a problem. If you want the economy to grow, it's a very simple input-output model. If you want more output, we need more inputs. And that could be capital investments, it could be technological change. But one of the core elements of a growing economy is simply more workers. We used to grow our labor force at 2% a year. Coming into the last decade, that dropped to 0.5% per year. Well, up until, of course, right after the pandemic, where we got a little bit of surge in labor force growth. Why? Well, you know, the solution to not having enough kids is more immigration. And that's exactly what happened post, of course, pandemic. We had a surge of immigration into the United States economy that caused a surge in both population and labor force growth. And this is what absolutely powered our economy forward. One of the big reasons for big growth numbers in 2022, 23, and 24 was indeed immigration. But a lot of these people, most of these people were undocumented because our legal systems are broken. And that bothers people. And I appreciate that. I understand that as well. Now, that being said, we have to understand that we need immigrants. We'd like to come in the legal system, but we don't have a legal system. They're coming in anyway. And, well, what are we going to do? Well, the best thing to do is fix the legal system, but that is nowhere near the current narratives in Washington, D.C. right now. But with the new administration, with the new actions of ICE, border crossings have come to a shrieking halt, and some people seem to be leaving. Again, is this good news or bad news? Well, on the right-hand side, this is the cumulative growth in labor force by nativity over the last 20 years inside the United States. 18 million workers have been added to our labor force over that period of time. Half of those people were born overseas. This is an immigrant-dependent nation. Not having those people coming here is going to flatten out the labor market and make it very hard for people to, well, grow their businesses because there's not going to be a lot of people to hire. This is going to be a drain on the economy. There's no doubt about it. And you can certainly see how it's warping our labor market numbers. Most of our labor force growth right now is 65 and older. We have lots of bachelor degrees, but folks in the middle part of the skills base, well, those populations are falling. And, well, we need all kind of workers to power our economy right now. Now, how does AI and the job apocalypse fit into this? Well, if you couldn't figure it out, there is no AI job apocalypse, at least not in the data. That seems to be strictly in the mind of the various folks running around screaming about this particular issue. And by the way, there's nothing new here. Here's a selection of headlines over the decades. March of Madness makes idle hands, 1928. Automation jobless, 1961. The robots are coming and so are the layoffs, 1983. Over and over and over, we heard these stories about how technology was going to get rid of jobs, and you know what? It's never happened. And indeed, as much as AI is transformative in certain ways, those are very specific ways. It's doing things that we've already gotten really good at. Look, 40 years ago, everything had to be typed up by the type pool. Now we all have word processors. We used to print stuff out and mail it. Now we email it all over the place. Obviously, this is another step in the process of taking all those electronic document processes and making them very quick and easy. But that said, we're not still fully comfortable with robot cars and trucks driving around. Only under very specific circumstances are we comfortable with that. And that's the issue. AI is really impressive online, but trying to translate into the real world doesn't work so well. It never does. It's kind of like that Dustin Hoffman character in Rain Man. Really good at some things, really bad at everything else. Indeed, look, I look to AI as a solution. If we're really not going to fix our legal immigration system and we got to pay off our debt and grow our economy, we need worker productivity growth. And this is exactly a solution to that particular situation. But we don't think that way. We think it's coming for our jobs, and we think inequality is growing, and we think that our real incomes are falling. Why? Well, you could do a whole lecture in this, but read Daniel Kahneman, Thinking Fast and Slow, which points out we think emotionally. We're not as rational as like we think we are. And Jonathan Haidt points out that when it comes to specific issues such as fairness, that's the inequality situation, we are programmed to think emotionally. We don't want to know the real answer. We like to think things are unfair. We lean into the unfairness, and that becomes the dominant narrative. And then you got to throw in Max Fisher, because look, these other two folks wrote about this in the general human sense. But Max Fisher talked about how the internet, the folks who run the internet, have realized that the best way to keep you glued to your screen is to punch you in your emotional buttons, to scare you, right? Or make you upset. Ergo, all these things are becoming magnified in this social media age. This is a true problem. It boils down to the basic fact that we don't think as much as we think we think. Take inflation. I've already showed you that real wages have been rising, and honestly, inflation has not been bad over the last couple of years. You know, the biggest source of inflation? It's not food, it's not housing, it's insurance, recreational services, and furnishings. That is, of course, the insurance crisis, which we know about, recreation services, those are tickets to go see concerts through Ticketmaster, and furnishings, well, those are those tariffs that were slapped on China a couple of years ago. But what about a gas? Isn't that going to upset everything? Well, look, yet again, I had to fill up my tank today. It was a $6 a gallon. That hurt. But then again, I go back in time and I remember back in 2010 paying $6 a gallon. And indeed, that's the key. One of the things to keep in mind is gas and oil prices are actually still fairly cheap once we adjust for overall prices. That's on the left-hand side. Oil price is about $100 a barrel after rising from $60 a barrel. But when you inflation adjust, guess what? That's lower than it was at any point in time from 2009 to 2014. And our economy did just fine. On the right-hand side, this is gas station sales as a percent of total retail. Again, we came into this with that number almost near a record low level. So a little bit of price increase, probably not that big of a deal. And part of the reason we're struggling, well, look on the left-hand side. This is a share of light trucks in auto purchases in the United States. In the last few years, in part because of cheap gasoline, over 80% of new cars being purchased are light trucks. They're F-150 pickup trucks and SUVs of various sorts. The one thing we haven't been buying a lot of is hybrids and electric cars. Indeed, those have started to drop off, particularly in the electric side of things over the course of the last couple of years. And remember, because of the changes in oil production in the U.S., given fracking and shale oil, well, last year the U.S. actually ran a trade surplus in oil and oil products. Yes, on net, this economy is made better off by the fact of we have higher oil prices. Look, if you ask me who really wanted a war with Iran, I know everybody says Israel. My personal opinion, Texas and Elon Musk, Tesla. These are the guys who wanted it, and I'm sure they're pretty happy at the $6 at the pump. Far bigger issue is insurance prices. And by the way, it's not just you, it's not just your neighborhood. It's life insurance, home insurance, auto insurance. All these premiums are going up dramatically over the last few years. Business insurance is going up. Why? Well, it's kind of a perfect storm. Higher claim costs. There are more claims for various reasons. Reinsurance has become more expensive. Regulatory compliance is higher. And one thing we don't talk enough, we have a litigation crisis in the United States right now. We are lawsuit happy in every single direction, and juries are handing out bigger and bigger awards because they're all panicked about inequality. Well, it feels good to give out that big war, to beat, you hit one against the man. But remember, the man's not paying that payout, the insurance company is, and that means in the end, we all pay for it through higher premiums. That's what's happening. We need to have a conversation about this, but again, we're not talking about this. We're focused on other issues. Now, one of the things I didn't talk about was tariffs. Why? Well, it turns out tariffs didn't matter all that much. Look, we're not a trade dependent nation. Imports and exports are 26% of GDP. That's tiny for most developed nations. Look, if you had used a 20% tariff on everything, that still only would have amounted to like a couple percent of overall GDP. Not a big number. And we didn't get close to that because our two biggest trading partners, Canada and Mexico, most of those goods were duty free because they met the conditions of the USMCA. Same thing with Taiwan for a whole different reason. Remember, trade agreements take precedent over executive action. Simple as that. In the end, we only collected about $180 billion dollars, and of that amount, I estimate about 40 billions were paid by consumers. I think it would have gone up a little bit over time, probably eventually would have increased to about 80 billion out of that amount, but it doesn't matter because the tariffs are gone away. Well, isn't this a good thing? Isn't this going to help the economy? Depends on how you want to think about it, right? From my perspective, yes, it's nice that the tariffs went away. What's not nice is we just lost $300 billion in revenue for the federal government this year. I told you we came into this year with the expectation of a $2 trillion deficit. Well, now it's 2.3 trillion. Oh, and they got to pay back 180 billion. Oh, we have 200 billion because of what's happening in the Middle East. You add it all up, and almost assuredly, this suggests that this could end up costing our nation an extra $500 billion in terms of additional borrowing. That's what we should be worried about. Look, I don't like tariff taxes. There are better taxes, but I do like government and defense spending. And I will tell you that any kind of tax is better than just ringing up more debt on the federal deficit. That's the wrong way of handling things. Now, with, of course, that situation with inflation burning off, the Fed's been able to back off. They've cut the federal funds rate. They've been able to engage in quantitative easing again. Their balance sheet is actually growing, hence interest rates are coming down. It's easier to get debt, all sorts of good things. Now, we are going to have a new chairman. A lot of folks are asking, how is he going to respond, particularly given inflation risk because of energy? And the answer is I don't know. Nobody does. The initial implication is that Kevin Warsh is an inflation hawk, which means tighter policies, but he's coming in about talking about cutting because that's how he's getting the job. So we just don't know. I don't know. We're just going to have to wait and see. And what about housing in all this? Where's housing? Well, a lot of folks think it's a terrible time to buy housing. In fact, I asked Google AI about it and told me housing affordability is a crisis level in the US. And of course, the administration is under a lot of pressure to make things better. But when you look at the housing market, it doesn't seem like it's something that's constrained by affordability. If anything, there's been a big increase in demand for housing, even with weak population growth. Suddenly, there's been a big decline in people per household. People are spreading out, and that's why we've been building a lot of homes, and vacancy rates are still quite low. Now, there's no doubt with the increase in prices and interest rates, affordability has gotten a lot worse relative to 2019. But 2019 was unusual for how affordable housing was, and that's because the narratives back then. We were running around telling everybody housing wasn't affordable when it absolutely was. And when you say housing isn't affordable, we got to be really clear about what we mean about that. If you own a house, you're in great shape. We have record levels of equity in homes right now, 400,000 debt to equity ratios still at record low levels. And median owner cost as a percent of household income is also at a decade low rate. So, in other words, current owners, they're fine. It's not current owners that are struggling, it's people who want to become owners. It's jumping into the market where the difficulty is. And it's really hard to get in the market right now because there is just nothing for sale, right? We know that home sales are just not moving, but then there's almost very little to buy. Look at that month supply in home on the right-hand side. And that's exactly just why, despite the so-called problem with affordability, you've not seen prices fall. In fact, they continue to rise in most parts of the United States right now. Now, it's hard to get into the market in part because filtering has broken down. Filtering, by the way, is a fancy process of building new homes at the top of the market, which is fine because a person in an entry-level home moves to that top home, and then the person living in the apartment who's ready to make the jump will go buy the starter home. But as you know, that person in the middle isn't moving because they have a 30-year fixed rate mortgage, and that's why it's hard for home builders to actually deliver housing in our housing supply constrained times because of the breakdown in the filtering mechanism, because of the fact that 70% of households have a mortgage rate below 5%. That is what's keeping people from moving. Hence, it's not a liquid market. Hence, you have to basically build where people want it, building townhouses, which is hard in a lot of markets because of zoning constraints and fixed costs. One way of doing this is to have a build to rent, a rent to own model, right? Build to rental markets. But even here, it's so odd, right? The number of single family rentals have actually been dropping over the course of the last decade. But we're quite positive that the number of corporate owned units are up. And now, of course, they just passed a bill in Senate targeting large investors and trying to prevent these, shall we say, build to rent models out there. Again, I just can't understand this. Now, who's benefiting from this, of course, are apartments themselves. Big increase in apartments out there, but the market overbuilt. And it's particularly in the South. You see the big increase in vacancy rates because they built out there. And as a result of that, particularly in the South and the Southeast, you could see the decline in rents. By the way, in all these markets where you have unaffordable housing, and the local folks are wondering what to do about it. Ask them, why don't you build more housing? We can see the result of that. Just look at Phoenix, Dallas, and Houston. If you really don't like the landlords, let them build everything they want. That'll teach them a lesson. And of course, renters are doing great just as well. Renter incomes on the right-hand side. You can see the breakdown on the left-hand side. A lot more higher income renters, lower income renters are dropping out. Yet, of course, everywhere you look, the big question is one of rental control. Everybody's worried about rent affordability, and exactly this is the problem. Rent control, when we don't have a rental crisis, rent control does far more harm than good in the long run. We're running at a crisis that doesn't actually exist. We don't have a affordable housing crisis. We don't even have much of a supply crisis, particularly in the Southeast. But nevertheless, this is the place we're going, and we're doing more harm than good. This is where I get frustrated. Bad narratives pushing bad policy. Now, it's not just local government. Talking about bad narratives pushing bad policy, go all the way back to the pandemic when the Federal Reserve, all those smart economists with their fancy degrees, all decided the pandemic was going to cause a depression, which is absolutely nonsensical. No pandemic ever has. I don't know why they thought it would. But they used that to justify $5 trillion in quantitative easing, a 40% increase in the money supply, which caused inflation. Of course, it caused inflation. And what's interesting is understanding the role inflation played in the 2024 elections. Look, why did Trump win? Why did Biden win? Why did, Obama win? Both parties like to claim mandates, but no party has a mandate in this nation. Over half of all voters are undeclared. They aren't a member of either party. Ergo, they vote on vibe. If they don't like what's happening in the economy, if that's their narrative, well, they vote the bums out. It doesn't matter who the other bums are. It works both ways. Both parties have to deal with this. And again, in 2024, people were upset about inflation. Who caused inflation? This guy. So, yeah, it's funny because, Trump doesn't like this guy. He's been so eager to get rid of this guy over the course of the last year, when honestly, he should have been sending him a thank you card, if anything. But Powell is leaving, and he's going to get his new guy, Warsh. We'll see how that works out. For those of you who think the consumer sentiment actually tells us about the economy, the University of Michigan kindly breaks down their sentiment index on the basis of political party. And just look how consumer sentiment moves around for Republicans and Democrats, just depending on the color of the party in the White House. Clearly, this is not about the economy. It's about people's political preconceptions. And that's always why when I look at the public sentiment index, I'm looking at narratives, not looking at economic trends. But again, look how negative these narratives are. All these kids now out there think that capitalism is stumbling for them at this particular point in time. And they went and elected Mondami in New York, a man who's an avowed socialist, which, by the way, New York doing the best they've ever had. It's amazing. But of course, when I see Mondami, who do I see? I see Donald Trump. Look, it's not just me doing this either. The Wall Street Journal made this point as well. Both of these guys, in the end, are populists. They both have ridden into power telling us how terrible everything is and how they're going to fix it. But it's not terrible, ergo, they're not going to be able to fix anything If anything, these kind of populist policies are going to do more harm than good in the long run. Look, the real threat to our economy is something I've talked about over and over, the federal deficit. And I know Americans have been talking about the federal deficit, economists have been talking about it for 40 years. You're bored of it. But it's different, right? Take a look at what's here. This is what I call the Keynesian cycle. It's the federal net lending and the U.S. unemployment rate. Nixon said we're all Keynesians now, which means he didn't believe in ISLM models. What it meant was that governments are required to lean in when we have business cycles, and that's what we do. Unemployment goes up, we borrow more to stimulate the economy. When unemployment goes back down again, well, so true should deficit spending come down. And that's been the pattern up till 2015. And in 2015, the wheels came off the train, and no matter what happens, our deficit has been getting larger and larger and larger. And the one big beautiful bill is just a continuation of the process. It didn't start it. It started under Obama. It went through Trump 1, continued through Biden, and now is continuing through Trump 2. This is a truly bipartisan effort. Both parties have a role in this mess. And of course, the reason we don't think about it is, well, when it's everyone's problem, it's no one's. The danger of federal debt is we all want to think it's somebody else's. It's not. It's all of ours. And when you think about it that way, you start to realize the danger. Look, our savings rate in the US is not 5%, it's negative 5% because government borrowing is our borrowing. Household debt is not 70% of GDP, it's 190% of GDP because government debt is our debt. This is the problem. But we're not thinking like that. We're not having these conversations. Thus, here we are. We're taking a fast walk down a short pier. When do we fall off? Well, you could think about the end of the Social Security Trust Fund, the Medicare Trust Fund. But look, let's just think about the current outlook for the deficit. This is CRFB, Center for Responsible Federal Budget, and this is their outlook. And it's based on CBO numbers, so it's reasonable, but there's a couple weird assumptions here. First of all, that top line, the alternative scenario, that's getting rid of tariff revenues. Another weird assumption is the idea that they're going to have the primary spending balance shrink, despite the fact that Medicare and Social Security spending is going to go through the roof because of all these new retirees. But the craziest assumption in here is the fact that they're assuming a 4% 10-year treasury rate forever. And that doesn't make any sense. Look, we have almost $40 trillion in debt. If the carrying cost of that debt goes up by a mere 1 percentage point, well, that will lead to almost a $500 billion more borrowing per year. We go from a 2.5 to a $3 trillion deficit. And then another percentage point, 3 to 3.5. And you can quickly see how this can spiral out of control. What can cause interest rates to go up? Well, I'm thinking about that financial bubble. One thing about the financial bubble is we've seen a tremendous amount of money pouring into the U.S. economy. They think they're buying equities, they think they're buying crypto. In the end, they're helping us fund our deficit. That again is where the danger lies. Now, what happens when that bubble finally pops? We don't have to guess. We saw it last year in the panic over the tariffs. When the stock market dropped, the dollar started to drop. And while the bond market initially started to rally and interest rates came down, it suddenly went the other direction and started going up in it. You could see it right there in that weird little down and up. What happened was at first the panic into the bonds, but then with the money flowing out, interest rates started to rise because there was simply less credit floating around. That is the impact. That's the thing that sets it off. You have the tech bubble pop, the money starts to flow out, and next thing you know, interest rates start to drift up. Inevitably, that will cascade to some sort of fiscal crisis, and it forces very quickly to deal with that particular imbalance. Now, when does this occur? How ugly does it look? So hard to say because it's all a function of narratives. But it's worth noting we're wobbly this year, and the thing I'm paying attention to, of course, is the dollar, which is still soft at this particular point in time, suggesting, of course, that foreign investors are on the fence about us right now. And if they decide to leave, things could get interesting really quick. So wrapping it all up, look, things are good right now. There's no doubt about it. There are some drags, but plenty of strengths, and everything suggests how the economy should continue to move forward. And for those of you thinking about housing, Don't walk away. It isn't that bad. It's certainly not going to get any cheaper. And look, owning a home is a great way to build up equity over the long run. I think you should go out and look for it, but beware the imbalances. Bubbles in the stock markets, too much government borrowing. None of these things are sustainable, and that's the basic rule. If it's going to have to come to an end, it's going to have to come to an end. All of this is simple. Fix immigration, raise taxes, cut public spending. But we won't do any of that. Why? Because of the biggest imbalance at all. It's exactly where we started, the imbalance between our narrative and our reality. It's easier to fool people than convince them they have been fooled. And unfortunately, we're a nation of very fooled people. Well, there you go, Roger. Got through most of that in a fairly good amount of time.
You
I know
did.
that
Covered a
was
lot of
quite a
ground. Always
yeah,
insightful, Chris. Thank you so
yeah,
much. A lot of great information. And I see a few questions in the queue, but for those who may still want to ask a question, but you haven't submitted it yet, again on the Zoom, you should be able to see that Q&A icon. Click on that and type in your question, and we'll try to get to as many of them as we have time for. So great job, Chris. Love your insights. And as we know, we talked to 10 economists. We might get 10 different answers. So, that's just the nature of the sport, at least in my experience. But Chris,
yeah.
clearly, his point of view and why, which I love. It's so, at least I find very easy to understand. So I'm going to take on a few, look for some themes here. Um, and I think some of these, come in, Chris, has come in at different points in the presentation. So there might be some things you addressed and some things that you haven't yet. So I'll just check in on some of them. So I'm just going to go back. So one, I think one is, will the Fed keep interest rates high? If so, what will be the effects? I know there's
Well,
been some different
yeah,
perspectives, and supposedly some dissension on the open market committee and such. So what do you
yeah.
think? And the new Fed chair we already
Well,
talked about.
couple things here. First of all, stop keying on the federal funds rate. All right, the federal funds rate is not the defining part of Fed policy. Now it's all about open market. I'm not open market operations. It's all about the Fed balance sheet. That is to say, are they shrinking or growing their balance sheet? Are they increasing assets or decreasing assets? The reason that's important is because when the Fed balance sheet goes up, the money supply in the U.S. increases, and increased money supply, at least in the short run, tends to push down interest rates and make credit more available to us. If you put too much money out there, it turns into inflation. But in the short run, that can give a boost to the economy. And I point out that while maybe they're sitting on the federal funds rate right now, they absolutely have been putting a little bit more money into the economy. And that is exactly why mortgage rates are running in the low sixes at this particular point in time. There are opportunities out there to get some cheap credit at this particular point in time. Um, Look, will they continue to be loose? I think that this administration wants them to be. And I will tell you, when it comes time that we have to deal with the fiscal situation, you can bet your bottom dollar Congress will have a handout asking for more quantitative easing from the Federal Reserve. And the reason for that is because Ben Bernanke, Janet Yellen, and Jerome Powell have all told us that quantitative easing does not cause inflation, despite the fact that that is a completely preposterous, provably false assertion. But they do so because of the public anger over the fact that the Fed caused inflation would obviously threaten the Fed's independence. They care more about Fed independence than they do about telling the American people the truth. And that is a slippery slope. That leads exactly to what every economist has said. When we have to deal with a deficit, we're going to inflate at least a portion of it away. So, did I answer the question? I didn't really. I dodged. What's the Fed going to do?
Well, I think you did pretty well. And as memory serves, the incoming Fed chair thinks the Fed's balance sheet should be smaller.
Uh-huh.
And so that'll be interesting to see what he's
Maybe he'll
able.
cut the federal funds rate and start shrinking the balance sheet again. And
I
by the
don't
way,
know.
what that will do is will spread out the yield curve, right? So then you would
Yes.
see the longer run rates start to go up again and shorter rates come down again. But remember, the Fed has to really pay attention to what its policies do to the federal budget deficit, right? I mean, they have that issue. And if interest rates start to go up, well, the federal government is going to be in a world of pain really quick. We're right on the edge.
Thanks, Chris.
Yeah.
One, and I'm going to try to paraphrase this a little bit. Just, I think a member is wanting to make sure this is an early question, so you might have addressed this, but I'll try to share it here, paraphrase it. Is just concerned about, are you considering like the impact of military spending and the war? I think I saw one slide. I don't know if it was the
Yeah.
request to Congress of 200 billion or something like that. But just because you know they're just concerned about kind of that the impact of the taking those funds out of the government and using it for war versus other purposes. Um,
But no, they
and
don't. They just act like they can spend whenever they want,
Yeah,
Roger. They don't care. And it's amazing because if you go back even 50 years ago, the federal government's feet were constantly being held to the fire on the basis of how much debt they were carrying. That was a big deal for a lot of Congresses and a lot of presidents for the vast majority of U.S. history. But somehow or other, in the last 40 years, we just stopped caring. And because we don't care, they don't care. They'll do it. They'll do whatever they want, wherever they want, and just borrow the money because
yeah,
they don't have to worry about us caring about it. And we're not going to care about it until all the people we borrow money from suddenly say, "Hey, can I get my money back?"
yeah, yes. Well, that $15,000 number you mentioned for every household was,
Yep,
that's a stark
that's
statistic,
our
in my
number.
view.
Right.
Someone was asking about income tax and just the general topic of income inequality. I know you showed some, kind of inflation adjusted, data and such. But one person specifically is asking, are you suggesting an income tax at every level of income? Is that the answer?
You
I
mean like a
and
flat
I'm
tax?
I'm assuming I don't know if that's the answer
No.
relative to income inequality and or some of the deficit issues.
Yeah, if I was gonna try and fix revenues, okay, there's spending fixes and there's revenue fixes, right? So for revenue fixes, what you've got to do is you got to raise taxes on the ultra wealthy. We got to close some of those loopholes that prevent them from realizing capital gains and all this kind of stuff, all the gamesmanship that goes on there. I'm not saying we need to crank up income taxes on the top 20%. It's really the top couple percent who've managed to avoid paying the same amount of taxes. I think it was I think it's some of those, shall we say, enlightened, very rich people who pointed out that a lot of them pay a lower tax rate than a lot of the people who work for them because their accountants are so good at finding loopholes. Well, we need to get rid of those loopholes. We need to raise those fundamental rates. We need to do so across the nation overall. There's no doubt about it. But then there's lots of other loopholes. Someone was telling me, here's a little loophole. They call it the master's rule. So there's a special provision that if you rent out your house for less than 2 weeks a year, you don't have to pay income tax. You don't have to pay sales taxes on or income taxes on it, right? On that revenue. Well, why not? Well, that's because there's a whole bunch of people who have houses on Augusta's golf course. Which, and for 1 week a year, we all know the weekend they do it, they rent out their houses for about $30,000 a pop. And because of their special little loophole, they don't have to pay taxes on that. What are we doing? I mean, cut it out, right? You got to simplify
Apparently,
the tax
Augusta
code.
has some good lobbyists.
Yeah. Well, that's just it.
So
By the way, go back to Reagan. You know what Reagan did? Reagan fixed taxes. Yes, he lowered them, but the big thing he did was he got rid of tons of these loopholes. And we need to go back. We need to have a major reform on our tax system to get rid of a lot of these loopholes, clean it up, make it more simple, make it more efficient, and just stop this nonsense.
one of the other things you had talked about, and I thought you raised a really good point, because I certainly see it not just in California, but we see it in the states we operate in. And there's a Wall Street Journal article this week about the impact of weather-related issues, I think primarily across the US.
Oh yeah.
But the members asking here is, and I think this is really in the context of these insurance cost increases, what is the size of increasing weather-related insurance claims versus the lawsuit payout issue? You were the kind of the litigant type trend, which is having I'm assuming the question is related to
Right,
which
right.
is having the bigger impact
Yeah,
on
I don't
insurance costs.
I don't know. It's the
Okay.
honest to God answer. It's very opaque. And remember, a lot of lawsuits never even go to trial. It's more or less modern extortion. There was an article in the LA Times not too long ago. One person has issued 1,600 lawsuits in Southern California over the course of the last 5 years.
You said one person?
One person,
Wow.
1,600 lawsuits in 5 years. It is doing it under the ADA. He'll go to any tiny little store in any corner of town and find one little thing that is not ADA compliant. And by the way, those rules can be really expensive. And they get a lawyer to basically write him a nasty letter saying, fix it and give us $20,000 or find yourself in court. And a lot of folks just, they can't take a chance. They can't take a chance of going to court. They can't even afford to defend themselves. And we let this crap happen.
Yeah. Another question relative to deficit, the debt is talking about kind of, I think, the issue of non-discretionary versus discretionary and the impact. So specifically, it's are we going to compare discretionary federal budget versus Social Security and Medicare? Because as I recall, federal spending, I forget, you probably have the percentages, but discretionary spending is a fairly small percentage relative to the non-discretionary, specifically like Social Security, Medicare, and such.
Right. And one of the things here to keep in mind, is everything I talked about today had to do with the funded liability, our existing debt, right? What we don't appreciate is the unfunded liabilities in the United States, which are promises for Social Security and Medicare and Medicaid that this nation has no ability to meet. Those trust funds are going to run out in 5 or 6 years. I've heard estimates as high as $50 trillion for our unfunded
Wow.
liabilities.
You said trillion with a T,
50,
right?
50 trillion. We have 40 trillion in fund. I'm sorry, it's higher than that. Sorry, it's 65 trillion. We have right now 40 trillion in funded liabilities, probably 60 to 65 trillion in unfunded liabilities, obligations in the future we're not going to be able to meet. Look, that's a overall debt to GDP ratio, funded unfunded, of 300%. It's just not sustainable, Roger.
Well, yeah, well, and I know a lot of people agree with you, although, others think the government's, they're going to do something, but again, it's going to create more debt.
They're
Someone
not going to do
related to
something about
this,
it.
at least it seems related to this topic, someone else is asking, in essence, should we be counting on Social Security for our retirement?
Look, Social Security trust fund runs out in like 7 years, 6 years. And technically speaking, when that runs out, everybody's Social Security check is going to get cut 27%. Now, not 100%, 27%. So can you count on Social Security? Somewhat, but don't count on it the way your parents counted on it. You know, boomers are getting away with murder. They built all these systems. They're going to ride these systems out, and they're going to leave us with the bill to pay. And that's an important form. I'm an Xer. I don't know about you, Roger, but I'm a Gen Xer.
Yeah, I'm
So
an extra as well. Yeah,
our brother.
yeah.
So yeah, but it's not just us. Europe has this problem. Most of Europe has this problem. China has this problem. Japan has this problem. It's a problem. That's as simple as that. And as we muddle forward, if do it by hook and by crook, we're going to have to be forced to deal with it. Simple as that.
One member is talking about kind of, are there any asset bubble kind of issues that we should be concerned about, specifically bringing up gold? Is that
Well,
something you look at?
no, because gold is a narrative asset. Look, gold doesn't have any value. I mean, it looks pretty. It's good for rings. There's some
Yeah,
electronic uses of it, but you can't live in it. You can't eat it. It doesn't give you a dividend. You can't. What do? You buy it because you think somebody's going to buy it from you for a higher price. That's a narrative investment. Now, get me wrong. Some people are really good at narratives. I'm sure there are people who have made money on gold. There are people who have made money on cryptocurrency. But me, myself, if I don't understand why it's worth what the price is, I ain't going to buy it. So, look, if you want to invest in crypto, if you want to invest in gold, more power to you. Me personally, I want to know what it's going to earn me. I want to know what the profits are. I want to know what the return is.
makes sense. Hey, Chris, I saw one request. I don't know if you could go back. I think it was the previous slide had your QR code on it. Someone was asking if we could leave it up for a little longer.
Sure,
I'm going to
absolutely.
give, I'm going to, I know we got a few, I mean, I got to major questions, not all. I did want to maybe switch over. We've got some of our New Vision leaders on.
Yeah,
We had one kind of more New Vision specific question that was asking about commercial real estate loans
yeah.
and do we make commercial real estate loans? And I know, like I saw, Lily and Tara, and there might be others. We got some of our, I'll choose them who they want. But someone's asking what states were current. So the short answer is yes, we make commercial real estate loans. The next question is, what are the states that we make in these loans? Is that something we can answer live, or is that, or I think we can, especially since you're here, Lily and Tara, and maybe others.
Hi, Roger.
Hi, Tara.
Tara, go ahead.
Thanks. Yes, you're right. The answer is yes, we do commercial real estate loans. We have 13 states that we lend in, and they're primarily in the West Coast region. So, but we do have the ability to lend in other states depending on the level of membership that we have. But and we can put into the chat and we can add those 13 states here for reference for ease versus going through them today. But yes, we do. Texas, Arizona, Washington, California, obviously Alaska. Those are our big states. Arizona, those are where our primary centers of focus are.
Great. Thank you, Tara. Really appreciate that. And again, I'll give you an email here as we wrap up. I'm not quite yet when I give Chris another opportunity, but if you're being interested in having us contact you, just put it, your contact information, send it to the email that I'll give you shortly, and we'll be happy to have somebody contact you if someone's interested in a commercial real estate loan. Chris, I think I'm kind of watching our time. There's always, never enough time to get everything, but again, this is recorded. But before I go to, maybe my closing comments, that'll be pretty short here. I just want to give you say thank you for being with us, and just I always love these interactions. I always learn from every presentation. I think our members do too. So I'm grateful to you being here and grateful for your just very plain spoken and articulate insights. So thank you. And I just wanted to see if you had any closing comments before I move to mine.
Look, we don't let the narrative get into your head. Make the choices on the basis of data and logic and a common sense. Don't let these screaming headlines. And I think a lot of people know this, but sometimes you just have to be reminded of that on a regular basis. And that's what I'm here to do. And by the way, I should also thank you, Roger. Look, I do a lot of work with credit unions in various sorts of places. And I just think the credit union system is a fantastic system. It takes care of its members. The members take care of it. And I'm glad I have an opportunity to do this with you.
Well, the feeling's mutual. Thank you so much, Chris. Thank you for being here and our, continual partnership. For our members, I alluded to, if you have, I know we didn't get to every question, but I tried to at least to get to the major themes that I could identify because some questions talked on the same, to the same issue. And I thought Chris did a great job. But if you want any follow-up on any questions maybe we didn't get to, or you think of something else, including like that commercial lending, or you want someone to contact you on that investment advice because we knew there was some interest, or just anything regarding these webinar, including any feedback for the next one, because we're going to keep, our plan is to keep doing these, and we're always open to feedback and how we can make them more valuable. You can send an email to newvisioninsights@newvisioncu.org. So Newvision Insights at newvisioncu.org. It's on the screen. And then, as I mentioned earlier, as a reminder, this webinar is recorded and it'll be available in our YouTube channel, as are the other ones. If you want to, take Chris up, at least I consider it an invitation, and you want to go see what he said last time and then compare it to what he said this time, and then you can let us know what you think, how well he did.
You might hear some of the same jokes. I apologize for that.
You might. You can do that there too, but we know many of our members can't attend the live session, so we hope you'll take and our New Vision Insights, the one we did back in February on protecting yourself from fraud, that's out there too. So again, a lot of great resources because that's what we want to do. Again, to provide you great information that then you can evaluate for yourselves and apply it, for your own life goals and your own family's, finances and goals. And hopefully we provide you information that helps you make the best decisions for you and your family. So again, thank you. Again, we appreciate your membership. We appreciate you taking part in this webinar, and we hope you have a great rest of your evening. Thank you, Chris. Thank you all.
Thank
Take
you.
care. Bye.